it's becoming quite obvious the role of stablecoins in their original use case. I believe synthetic dollars are set to ignite the next crypto boom, pushing the market cap well beyond its previous high of a measly $2.8 trillion, up towards something closer to about $10 trillion in a very short period of time. Now that the petrodollar is done, how will the U.S. government and the Federal Reserve keep this dollar Ponzi scheme going? Is what you should be asking yourself. In this recent piece by the Wall Street Journal entitled "Crypto Could Save U.S. of a U.S. Debt Crisis" could be the answer, because as it says, stablecoins could provide demand for U.S. public debt. And so that means the Treasury and the Federal Reserve will step in to maintain dollar demand by creating liquidity that could boost the entire crypto market to heights we couldn't imagine. While I believe that stablecoins like Tether will drive this surge, especially propelling Bitcoin to those six-figure digits that all the maxis are excited about. So ultimately, this artificial liquidity gives the Federal Reserve more time before they actually need to pivot and lower interest rates. So the question is, will this strategy save the dollar and spark an unprecedented global crypto boom? But let's talk about this one. All right, so this is going to be a doozy. It is not coincidental that less than a week ago, Saudi Arabia decided to not renew their agreement with the Petro-Dollar system. And then shortly thereafter, literally 5 days later, the Wall Street Journal releases an op-ed piece basically saying that the Treasury and DeFi Llama have been working together, and they think that stablecoins can be a viable option to continue to provide global dollar support. At the same time, the U.S. Treasury is in need of buyers of our national debt. And so everything is starting to make sense to me. And so I put together all my thoughts and deliver another quick take, highlighting how this upcoming crypto pump is not by accident and will be intentional for many reasons. But one, the government needs buyers for their debt. Two, the Biden administration don't want to get behind now that Trump is pro-Bitcoin. So they're about to switch their tune. Therefore, regulatory clarity will become more clear. Three, what better way to keep the narrative going that the economy is booming by letting Bitcoin and other cryptos just rip through the roof heading into this November's presidential election. So as always, for those who find short, quick takes informative, this is the time where you hit the thumbs up button. And if you find any value here, please share this video so more people can find out what's really going on. And on my end, as an opportunist, whenever I see opportunities to take advantage of, I'd be a fool not to pay attention to it and try to package it all together and deliver it to you guys on what could be some life-changing returns for those who like to speculate in this space. But then again, I like to stay true to my roots as a monetary enthusiast, and in particular focusing on silver. And that's why I'm excited to start the RTD Silver Team, where my desire is to help 1,000 households simplify their silver accumulation by being able to dollar cost average in on a monthly basis, allowing them to get their weights up without the hassle of having to worry about price and things of that nature. So if you guys are interested in finding out more about the RTD Silver Team, click the link in the description, watch the short video there, and then join us in reclaiming your right to hold something real and tangible in your hand, i.e. the people's money. So as I mentioned, now that the petrodollar system has come to an end, the U.S. is going to need some buyers of U.S. debt in the near future because the auctions aren't doing too well. Here it says Treasury bond auctions may eventually fall because investors will see federal deficit as too unsustainable. And clearly that will be the case because this year alone, $10 trillion in U.S. Treasuries is coming to the market. People aren't racing to buy those things like they used to. And if this year alone isn't bad enough, according to Lynn Alden, the Congressional Budget Office expects that about $20 trillion in net new federal debt will be issued over the next decade. And as part of this, they assume that one, there'll be no recessions, but also that interest rates will go down starting sometime this year. So otherwise, we should expect a lot more than just 20 trillion within the next decade. So there we have 10 trillion this year, then allegedly 20 trillion over the next decade. That's 30 trillion right there. And now that the petrodollar deal is no longer in place, that means nations don't have to hold U.S. liabilities, aka our debt, for oil because there'll be other alternatives. And so now the Biden administration is coming around to their senses on crypto. And so as I mentioned, 1 week after Trump mentioned his desire to unravel the Biden administration's anti-crypto stance, the Biden administration, along with Mark Cuban, are reportedly set for a high-stakes Bitcoin roundtable in D.C. So we have the petrodollar ending, the U.S. government needing a buyer, and the U.S. changing their stance on crypto, all signals that there will be a need for a large amount of liquidity starting this summer, especially heading into the winter months. So we can tell the goal is to not have the Federal Reserve pivot completely too soon by lowering interest rates. So they need another way to create this liquidity, and that brings in the stable coins. And that takes us to this article that came out on June 13th that says crypto could stave off a U.S. debt crisis. And as I scroll down, it talks about the current debt issue that the U.S. has and the fact that nations are turning their back on the USA. But then it says here, according to the Treasury Department and DeFi Llama, a cryptocurrency analytics site, dollar-backed stablecoins are becoming an important net purchaser of U.S. government debt. It says if fiat-backed dollar stablecoins issuers were a country, it would sit just outside the top 10 in countries holding treasuries, smaller than Hong Kong, but larger than Saudi Arabia. If the sector continues to grow, stablecoins could become one of the largest purchaser of U.S. government debt and a reliable source of new demand. And so if it keeps growing, more likely, how fast does it grow? As we can see here, here's a list of the entire catalog of US dollar-backed stablecoins. And of course, the biggest one is USDT or Tether. But then again, here we have a long list of stablecoins that's circulating around the world that the US government can use as a proxy or an additional tool to create artificial demand by extending the lifeline of the dollar a little bit longer, by continuing to issue a large amount of debt, and then have some of these companies take that debt on their balance sheet and issue new dollars into circulation. And at this current moment, we can see that the market for stablecoins is not that large. And as of right now, there's approximately 149 billion worth of stablecoins in the market, with approximately $10 trillion in debt coming into existence this year. It's good to say between now going into 2026, we can see a surge in the stablecoin activity. And as always, when a stablecoin are created out of thin air, such as the way Tether does, it always flows right into Bitcoin and into the other cryptos. And so as we can see here, from the very creation of Tether at around 2014 or so, the market cap was $251,000. And of course, every crypto surge, a lot of these fiat-backed stablecoins are what helped drive the Bitcoin price up and the overall crypto market. And so from 2.19 billion around the peak of the very first boom up to 153 billion in 2022, it's good to say there's a lot of room to the tune of trillions that might be brought into existence in a very short time. And that's one thing I've always kept an eye on as a spectator in the space, because wherever liquidity flows, the pumps usually follow. And so this is going to turn into one way that the government can extend their lifeline for the dollar, because they're creating a artificial demand with synthetic dollars. And this ultimately buys Uncle Sam more time. And one of the best analogies as to the new role of this synthetic dollar is comparable to the Eurodollar. In the same article by Wall Street Journal, when I scroll down, there's another interesting comparison to the synthetic dollar to the Eurodollar, which has also been a tool used to provide liquidity throughout the world for the last several decades. It says here, most stablecoins are held by investors in countries with weak economies and underlying institutions that are looking for better money. As Timothy G. Massett, a former chairman of the Commodity Future Trading Commission, recently described in a Brookings Institution research paper, he says, stablecoins are analogous to Eurodollars, the offshore dollar-denominated liabilities that turbocharged the dollar preeminence during the Cold War. So ultimately saying that following the Cold War was also used to extend the lifeline of the dollar heading to the whole closing of the Nixon window, because as a Bretton Woods agreement was coming to an end due to the expansion of the monetary supply in the U.S., the Eurodollar mechanism was a part of that pipeline that flooded the world with dollars. And so for those who may not be familiar with it, the creation of the Eurodollar system in the 1950s was a crucial mechanism created by the banking cartel to keep this dollar system thriving. And if you guys want to find out more about key events that really impacted the dollar, I encourage you to check out the latest update to the dollar K infographic, which you can find in the description beneath this video here. And it does a good job of covering a lot of monetary events that impacts the dollar. I consider this a complete dollarcation, or the monetary cheat sheet with information we didn't learn in school. And so as it stands today, with stablecoins being introduced as an official mechanism for the U.S. Treasury to use as a way to create artificial demand for treasuries, it's only natural going to circulate into the crypto market as well and all the other financial sectors. As a speculator, it's definitely worth paying attention to where the funds flow. And that means the cryptocurrency market will surge. And that's not even including the possibility of the Federal Reserve deciding to pivot, there being some type of deflationary bubble collapse, and then them coming in with the monetary printers and reinflating the world economy like we've never imagined before. And so how does the crypto market get to 10 trillion or so or beyond? Simple. The stablecoin creation will go in hyperdrive real soon, creating an additional 2, 3, 4 trillion within a couple months or maybe even a year. And then you factor in the Federal Reserve when they decide to pivot after some type of market correction, more than likely. That's another 5, 6 trillion just for starters. And so for those who are excited about cryptocurrency, you can definitely see $100, $200, $300,000 Bitcoin, and then all the other cryptos underneath also being pumped, just because the overall market cap will be at astronomical highs. And it's my suspicion that this next market pump for crypto, which will be the fourth one since the advent of Bitcoin, might be the last one of its kind. Just because after this next pump, we're going to enter a world in which banking is going to be problematic because of commercial real estate and all the debt issues that they're experiencing. Then we got 2 years before all the CBDCs globally will be rolled out, and crypto's at an all-time high poses a severe threat for the government's ability to continue to control people's financial affairs. And then third, the overall state of the global economy will be completely restructured because of all the BRICS activity, and of course the commodity space with gold and silver being recipients of these trillions of dollars being brought into existence, as well as base metals and minerals and things of that nature. So things are going to get extremely crazy. But in the end, there's always opportunity if you know where to be ahead of time. And so based upon previous liquidity surges into the market, it always goes into crypto first, because that's where they want this to go. It excites the public and it buys the banker more time to pull off their heist with the issuance of CBDCs as well as those tokenized assets. But going back to the very first pump of cryptos back in 2013, the market got up to about $13.8 billion in 2013. And then the second pump got up to $705 billion. And we all know the most recent pump up to $2.82 trillion. And so right now, hovering around 2.4 trillion is peanuts compared to where this thing can go. It can literally shoot off the charts when this stablecoin liquidity is brought back into the markets or the Fed pivots, either one. And so within all that lies opportunity to make life-changing gains in USD terms, while there's still another taker on the other end of that trade in those US dollar terms. And so based upon all the things I laid out here, the liquidity will come because stablecoins will be a catalyst that will be used in the interim. And then eventually the Federal Reserve and Treasury will usher in something new down the line. But then again, there's opportunities. And so for those who speculate directly within the crypto space with individual projects and stuff like that, you'll be a recipient of a lot of those gains. But then again, there's always alternatives as well. There are additional financial products that allows you to exposure to the space that's attracting a lot of investor attention in the US, in addition to the recent Bitcoin ETF announcements. I recently came across DeFi technology trading under the ticker DEFTF, which appears to be a very exciting company making waves in the crypto industry. They currently have over 500 million in assets under management and led by notable figures like Anthony Popliano, with a few key partnerships with Hive blockchain technology, Bitcoin Suisse, and Neuronomics, just to name a few. Their crown jewel, which is Valor, creates ETPs or exchange traded products, offering exposure to cryptocurrency like Bitcoin and Ethereum in markets where ETFs aren't available just yet. With a projected annualized operating revenue of 119 million just this year, DeFi Technologies represents a significant growth potential, with analysts predicting a staggering 400% upside. And so here's a look at some of their products inside the ETPs, which includes Ethereum staking, Cardano, Polkadot ETP, Solana, Uniswap, Avalanche, just to name a few. And if you want to get more information and to take a closer look, visit www.defi.tech, where there you can learn more about their asset under management and stay up to date with the current news that everyone is talking about. And so there you have it. The potential of the liquidity surge through stablecoins is real, and it's going to impact every financial sector, and the crypto sector first and foremost, in my opinion. And so once again, just present opportunities to you guys for those who actually speculate with the assets themselves, whether it be Bitcoin, Ethereum, or any other potentially 2,000 networks that are not operational, or for those who might have interest in just parking some funds perhaps in the ETP product I mentioned from DeFi Technology. All could be viable options for those who recognize the opportunity that may be in front of them while it lasts. But anyway, curious to hear your thoughts. Drop a comment down below, and if you find value here, definitely hit that thumbs up button, share this so more people can find out what's going on, and I'll catch you on the next RTD Quick Take. See you later.